Let's jump right in with a number that honestly just blows my mind. 70% to 90%. According to extensive market research, that is the percentage of retail intraday traders who end up failing over a sustained period. I mean, it's a massive failure rate, right? And it immediately makes you wonder, are financial markets really just some rigged, impossible casino? Or is there a huge, fundamental flaw in how most of us are actually approaching them?
Well, the real difference between gambling and trading actually boils down to just two words: position sizing. You see, the main villain that's destroying these retail accounts, it isn't a fundamentally bad strategy. It's not a lack of market knowledge, and it's not even picking the wrong assets. The absolute account destroyer is emotional sizing and poor risk management. It's us. It's the human element.
So that brings us to the ultimate question, doesn't it? Why do traders blow up their accounts 60% of the time, even when they literally have winning setups? In this explainer, we're going to answer exactly why traders fail. But more importantly, we're going to see how shifting your entire paradigm, moving away from desperately guessing entry signals to mastering mathematical survival, literally changes everything about your trajectory in the markets.
Welcome to the explainer. Today, we are breaking down the exact mathematical risk frameworks that professional and institutional traders use to survive the market. We are moving way beyond the basics here to uncover the hidden architecture behind consistent profitability.
So here's our roadmap for today. We're going to cover the math of survival, fixed fractional and Kelly criteria, scaling with market volatility, the mathematics of reward, hidden market risks, and finally, building a hybrid system. Let's get into it.
Section 1. The mathematics of survival.
Okay, to really grasp the math, we first have to understand the mind. You see, traders blow up because deep-rooted cognitive biases totally hijack their logic. Think about it. During a winning streak, your position sizing suddenly, magically expands because of overconfidence bias. And then, when a loss inevitably hits, bam, revenge trading kicks in. People size up massively trying to make that money back, literally erasing weeks of disciplined progress in a single catastrophic afternoon.
So to overcome these catastrophic behavioral biases, we have to completely remove raw emotion from the cockpit. We need to treat every single trade not as some gut feeling or a hunch, but as a strict exercise in pure mathematical precision. Section 2. Fixed fractional and Kelly. The absolute foundation here starts with what's known as the 1% rule. By risking a static 1 to 2% of your equity per trade, a really fascinating mathematical phenomenon kicks in. As you take losses, your absolute dollar risk actually decreases during drawdowns, simply because 1% of a smaller account is a smaller dollar amount. This acts like an automatic brake, preserving your account when your strategy underperforms. By doing this, you could literally suffer 20 consecutive losses and still have over 80% of your capital completely intact. It keeps you in the game.
Now, you might be wondering, what if I want to optimize for maximum growth? Enter the Kelly criterion. Developed back in 1956, this formula calculates the exact fraction of your capital to risk to mathematically maximize long-term compounding. But there's a pretty huge catch here. While it represents the absolute mathematical ceiling for growth, applying the full Kelly exposes you to extreme volatility and terrifying 99% drawdowns. Yeah, 99%. That is exactly why professionals dilute it. They use fractional Kelly approaches, like risking maybe half or a quarter of the Kelly recommendation, just to balance that growth with, basic sanity.
Section 3. Scaling with market volatility.
Now, a static percentage kind of ignores the changing environment, right? To solve for this, sophisticated systems deploy the average true range, or ATR. It's a technical indicator measuring the absolute magnitude of recent price movements to account for everyday market noise. Legendary groups like the famous turtle traders back in the 1980s used ATR to dynamically adjust their position sizes inversely to recent price volatility.
Let's look at how this plays out in practice. When the market is super calm, low volatility, the ATR is narrow. This allows you to buy more shares with a tighter stop. But when the market is turbulent, high volatility, the ATR gets wide. That mandates a wider stop loss, meaning you've got to buy fewer shares just to filter out the noise. The beauty here is that your exact dollar risk remains perfectly equalized in both scenarios.
Section 4. The mathematics of reward. Okay, this is a massive light bulb moment for so many people. If you size your positions to ensure your winners are exactly twice the size of your losers, so a 1 to 2 risk-to-reward ratio, you only need to be right 33.3% of the time just to break even. Let that sink in for a second. You can literally be wrong twice as often as you are right and still survive and have a robust system. This right here is the mathematical edge professionals rely on.
But to protect that mathematical edge, you absolutely need a failsafe. And that failsafe is typically 3%. Institutional traders deploy these strict circuit breakers, commonly capping their maximum daily loss at 3% across all open positions. If they hit down 3%, they're terminal locks, period. They are done for the day. It completely short-circuits that emotional revenge trading bias we talked about earlier.
Section 5. Market Structure, Hidden Risks.
We also have to remember that the math doesn't exist in a vacuum. Different environments demand radically different rules. In traditional equities, the market closes. This creates overnight gap risk, or some bad news can cause a stock to open way below your stop loss, destroying a 1% risk model instantly. Crypto markets, on the flip side, operate 24/7. So while that eliminates gap risk, the extreme leverage in that ecosystem threatens you with sudden liquidation cascades and massive slippage.
And hey, even our advanced volatility scaling has a blind spot. ATR models are mathematically backward-looking. They rely on historical data. This means a sudden black swan event, like a massive global shock, can cause cascading losses way before your indicators ever have the time to adjust to the new violent regime.
Section 6. Building a hybrid system.
So how do we bring this all together? Here is the exact process professionals use. It's the volatility-adjusted fixed fractional framework. Step 1, you check the circuit breaker. Are you within your 3% daily limit? Step 2, you measure current market noise and place your stop loss using an ATR multiplier. Step 3, you size the trade so that if that ATR stop is hit, you lose exactly 1% of your account. It's systematic, it's completely repeatable, and it is totally devoid of emotion. By bounding your trade size with fixed fractional limits, adjusting your leverage dynamically based on volatility, and strictly enforcing those daily circuit breakers, you build a comprehensive, multi-layered system, one that is genuinely capable of surviving virtually any market regime.
As we wrap up this explainer, I really want to leave you with a final thought to chew on. Take a hard, honest look at your own trading portfolio. Based on your current rules, are you truly mathematically prepared to survive the next sudden market crash, or are you just gambling? Think about it, and we'll catch you in the next explainer.